Welcome back. You're tuned in to CNBC-TV18. We're coming to you live from CNBC-TV18 Motilal Oswal studio. Well, the SGX Nifty suggesting actually a bit of a downtick to kickstart trade. Let's get in our technical experts, Sudarshan as well as Mitesh. They are with us early this morning. Morning, gentlemen. Sudarshan, you go first. What's your trade on the index? We had a good close on Friday. It was a very, very strong close. Do you think we're good for more, or do you think we'll see a bit of a downtick?
Yeah, good morning. See, markets can move differently for a very short period of time. So I'm not forecasting what will happen in the first hour or second hour. But the broad view is that this market is likely to move up. So if we see a downtick, or a gap down, this is an opportunity to go long in the Nifty. There was a significant resistance at 17,800. We did cross it on Friday, but apparently we will again retreat, and that resistance should hold for some period of time. The moment we cross 17,100, 800 in the cash Nifty, buying is suggested. I would not go short at all using this. This is not a short seller's market. It's a buy on dips or buy at 17,800 market.
Okay, so it's a buy on dips market. Got that. Mitesh, would you agree that at some point a buy is, perhaps the most prudent thing to do? And what are the levels to watch?
I think we're trading with more of long buys very clearly. But on the index, I'm avoiding a trade because it's basically choppy within some kind of boundaries. So I think 18,000, 18,100. I think if you want to trade for that movement, yes, I think it will be a buy on dips or a buy kind of a market when you would explore more long positions on the index. And my sense is that I think looking at the targets of around 18,100 or thereabouts. The stop loss here should be placed closer to or just below 17,750 on the Nifty spot. These are all spot levels. So, yes, I think a mild long trade can be done. But the bigger trend still is not very clear. I think it's still choppy and basically broadly consolidated.
What about stock specific? Mitesh, what are you looking at?
Morning, Ajay. I have more of long calls, buy ideas, 3 buy calls to a sell. Bajaj Auto, I think after a few days of pullback on Friday had a very good candlestick pattern and the overall setup is positive. So that's a buy. 38.20 is the stop loss. 39.25 is the near-term target. Britannia is something which I've recommended in the last few days and I continue to maintain a very strong and a positive bias over here. So trading bet, that's a fresh buy with a stop below 4,600 for a target of 4,700 plus. The third buy call is Indian Hotels. Recommend here buying with a stop at about 312 for targets of 330. And one sell call on DVs. Obviously, after the numbers, I think the stock had a very big, massive breakdown. So mild pullback would be a good levels to go short. Keep a stop at 29.10 here and a first target of 2,800 on the downside.
All right. And Sudarshan, what about you?
Well, see, the Bank Nifty is finally putting its act together. So I'm looking at a buy in AU Bank, which went to a small bear market, is now moving sideways and gives signs of actually beginning to rise. Buy AU Bank with a stop under 615. Hind Liver is a buy. The stock has been outperforming after a big move on Thursday. On Friday, it had a pause, a rest. That's normal. Now I'm assuming either today or tomorrow, it should again resume its upward move. Buy Liver with a stop under 25.50. Tata Power is my only short sell. Its short selling should be done only intraday. Sell with a stop above 209. It's a stock that is moving sideways. And SBI Card was in a bear market. That also seems to be now suggesting that the decline may be over. Okay, so this is another buy on dips opportunity with a stop under 730.
Okay, all right. Got that, gentlemen. Thanks so much for giving us your take on the index as well as the individual stocks. Well, let's get back to Prakash, the one who's been waiting by. Prakash, before we let you go, I wanted your view on Ambuja Cements. Now, one part of the street believes that the deal happened at around 385. So at least, that could be the price that you get in the near term. While the flip side is, in the other part, the bearish sentiment is Ambuja never traded at such elevated levels. The re-rating was done only post Adani taking over. How would you look at the stock? It had a big recovery in Friday's trading session at around 370 odd. Your view?
So Nigel, that's a very important point that you raised because, there is a price anchoring bias here. Because the offer price was at a particular level and if you see the stock recede from there or is available below that, you tend to kind of start seeing value in it. But remember, this acquisition was fairly aggressive given that, the acquirers were not from the cement business. It was not something which was a sideways acquisition. It was an absolutely new thing for them. And they've overpaid for it because of the kind of scale and size that they've been seeking. The other players probably didn't offer that aggressive a price for the simple reason that to sweat an asset like this, you would need to restructure it quite significantly. And that's going to be a time cost, if not just financial cost. So people have to live with the fact that if Ambuja has to start delivering great value from this level, it'll take it at least 3 years, 4 years, because given the kind of capacity expansion in the market, I mean, you see the numbers, some of the mid-sized players are struggling to get margins to be even at the same level as last year, whether it was a Birla Corp or JK Cement, except for Dalmia Bharat, which I like because of the kind of internals that they have, the kind of efficiencies that they have. It's going to be extremely difficult for people to ramp up volumes as well as, improve on profitability. So there's going to be a long winter for most of these large cement players, including the likes of Ultratech. While things look definitely very rosy in a longer term, but in the next year or so, it's going to be a lot of challenges. So I won't jump at it, but you would look at it separately. Forget that 385 is the reference price. Whether at 340, 350, 370, does it offer value, and at what time it takes for you to get this relevant ROEs. So I think the ideal band would be closer to 350 and between 330 and 350. If it comes into that zone, you'll probably be much better off. But don't jump at it just because it's less than 385.
Okay, well, thanks a lot, Prakash, for joining in. It's 9:06, so we're heading into the pre-opening rates. But the Adani Group crisis is something that has everyone on tenterhooks. In fact, the crisis has only deepened as the market cap of the group has halved since the Hindenburg report. The latest is that report suggesting that Standard Chartered has stopped lending against Adani dollar bonds. Hetal Dalal, the president and COO at IIAS, joins in now to discuss more on the way forward and what could happen with the group. Hetal, thanks a lot for joining in and thanks for waiting by patiently. Is there now a risk of insolvency? And if yes, what is the impact that this would have on banks? I mean, Uday Kotak put out a tweet saying that there's no systemic risk, but now we see banks like Stancy have stopped lending against the Adani dollar bonds. What do you see as the way forward?
Well, thank you for inviting me. I think we're a little away from an insolvency risk. I think, yes, the group is struggling to raise debt, especially in the global markets. Depending upon where their sort of immediate repayment pressures are, whether they have the liquidity to repay, I suspect there will be ways and means in which the group will be able to find the cash flow. I think businesses from an operating perspective are doing reasonably well, and therefore there will be a certain degree of cash flow that they will be able to pull out. The issue for them is essentially the fact that the markets are now, from a lending perspective, becoming tighter. And it is only, I suspect, only if they are able to bring in greater clarity and stabilize what is currently happening, that these markets may open up for them at this point in time.
Okay, all right. Hetal, request you to just stay with us for a minute or so. Prashant is getting some updates in terms of SEBI looking at various FPI registrations. Tell us more about that, Prashant.
Oh, absolutely, Nigel. I mean, and this is an important story that we are putting out right now. This is a CNBC-TV18 exclusive. What we understand from industry sources is that SEBI has written an email to banks who deal with foreign portfolio investor registrations. Now, this is via email. This is not a circular, so you will not find this on the SEBI website or anything. This was an email which was sent out on Friday evening, last Friday evening, with a focus basically on two issues. One, FPI registration, and number two, beneficial ownership. Now, let me explain. So what is SEBI saying? SEBI is asking what are called designated depository participants to reach out to their FPIs by 31st March 2023. Designated depository participants, DDPs, by the way, are units within banks who deal with the process of FPI registration. So, these are the guys who get them on board, FPIs on board, register them. So, SEBI is asking these DDPs to ask their FPIs who've registered with them, to give them the updated beneficial owner details by the 30th of September 2023. So, there are very clear timelines here from SEBI. Now, the SEBI communication says that if this is not done by the 30th of September 2023, which is this year, these FPIs will become ineligible to continue the registration, which then, according to the SEBI communication, means that they will have, these FPIs will have to sell their holdings by the 31st of March 2024. I would like to very clearly add that we have written to SEBI for a comment and we are awaiting a response from them. Now, I want to just explain this issue a little bit more. As I said, SEBI is focusing on two things. On number one, on the registration of FPIs. Let me take an example. If, for example, there is a German bank or a US bank which is a unit based out of Hong Kong or Singapore or somewhere else which invests as an FPI in India, SEBI is basically saying that the legal entity is not the unit which is operating out of Hong Kong, Singapore, etc., but it is the sort of end German bank or the US bank of, the unit of the main entity is the legal entity here. So the German or the US bank is the legal entity, not these units which are operating out of Singapore, Hong Kong, etc. The second issue, the SEBI communication touches upon is identification of beneficial ownership. So if there is an FPI investing in India and there is no entity investing in this FPI, which is given the FPI money, which can be identified as a owner, there is a 10% threshold, right? So if there is a $100 million fund, ownership is anybody who has more than $10 million invested in the fund out of the 100 million. So 10% is the threshold. And number two is control, right? So if there is no natural kind of ownership or control, then the beneficiary owner, according to SEBI, has to be a senior person, a very senior person, and not some junior person or even somebody who's actually managing money, etc. It has to be a managing partner level of a person, a senior person who has to be identified. All in all, clear communication. The regulator wants to know the end beneficial owner of FPIs, and there are clear timelines given by it and by when it wants this information by. As I said, again, we've written to SEBI and are awaiting a response from them. Hetal, of course, is with us. Hetal, any thoughts on what I just kind of put out in terms of this story and what SEBI is seeking here? Go on.
SEBI is seeking greater clarity around ownership structures. Not necessarily. One is, of course, whether these belong to the controlling shareholder. The other is whether these are public shareholders and effectively the beneficial owners somewhere tie back to the promoters. It's in terms of the way SEBI is approaching it. They've sent an email from what you're saying, and I think there is a certain degree to get more clarity around these issues. And if there is greater clarity on the beneficial owner, the actual shareholding, whether classified as public or promoter, depending upon how legally it's taken, at least the actual sort of control will get established with a little bit more clarity. I don't know if this is in reaction to what's happening with the Adani Hindenburg report, but nevertheless, in our view, of course, this is just brings more clarity in terms of the ownership structure.
Okay, more clarity in terms of the ownership structure. So you said a while back that there's still a little time away from perhaps insolvency hitting the group. But, many of the businesses that the Adani Group has have very long gestation periods, long gestation infrastructure projects as well. The question is that will they have enough cash generation going forward to kind of go through with these projects, because that will be then another big issue that many of these projects across real estate infrastructure don't see the light of day. Is that a concern?
See, I think at this point in time, the rating agencies haven't downgraded the ratings. All the ratings are currently in investment grade. And therefore, for us to jump to a conclusion saying that there will be an immediate liquidity stress and there will be a concern over insolvency, I think is perhaps a little too aggressive. There is concern over how much group debt there is, and that is a number which has been floating around the market with not as much clarity. And that could be an overhang as far as the group is concerned. But at this stage, I think, and you're right that, and let me answer your question in terms of the fact that there are long gestation projects in some of the companies. A lot of the bankers have said that these are again collateralized and that this is not against a lot of the debt is not against equity per se. And therefore, the drop in market valuation need not necessarily have an immediate impact on the group's repayment capacity as of right now, or in terms of its quality of collateral. It does, as we see, impact the ability of the group to refinance its debt. And I think if there were a near-term liquidity crisis, you would see the ratings collapse far more quickly than you're seeing now.
Okay, Hetal, we'll leave it at that. Thanks a lot for joining in and giving us your quick take on what the group could be looking at in terms of the crisis and the way forward as well. By the way, just wanted to mention a couple of stocks in pre-opening. Divi's Laboratories is one of the biggest losers. Remember, the EBITDA margin that Divi's hit at 24% was the lowest ever in the history of the company. So Divi's is your big loser at the moment. Just 20 seconds left for the market to open. Of course, SBI, ITC, Indigo, Tata Power, Paytm will all be reacting on the upside to their numbers. Marico, volume growth was just about okay, 4%. So let's see how that goes. But of course, all eyes will also be on the Adani Group stocks. For now, the first tick on the Nifty, at least in pre-opening, was indicating that the start will be slightly in the red. Here you go. That's the opening bell for you. Well, as I mentioned, slightly in the red for the market. The Sensex and the Nifty down about 0.2%. The Bank Nifty absolutely flat with a bit of a negative bias. What's dragging is once again Adani Group stocks, Adani Enterprises, Adani Ports, a downgrade coming in there as well, so down almost about 1% odd. Divi's Lab down about 1% on the back of weak margins there. Tata Steel ahead of its numbers today is down 1.5%, so just keep that on your radar. And then you have a couple of other names like HCL Tech, HUL, Axis Bank that are under a little bit of pressure. But Adani Group stocks getting hit hard now. Adani Enterprises down almost 7% straight off the back. On the upside, ITC SBI holding up. You have Hero Moto comes out with numbers this week, so up about 0.2%. M&M has been doing well. You have L&T that's been gaining ground ever since the budget, so up 0.6%. And ITC, of course, is your top mover at the moment. A couple of other movers in the broader markets include, Paytm, which is up 7% now. Vodafone Idea and Indus Towers both up almost 10% odd. So just keep that on your list as well. But all in all, you'd have to say muted start for the market. I think SBI, ITC holding it up, and then you have Adani Group stocks on the downside.
Well, that's right, Sonia. And as you mentioned, the big movers in the broader market really are Vodafone as well as Indus Towers. Both of them, in fact, they're in temporary upper freeze. So just keep an eye out on that front. Mahindra & Mahindra Financial, well, we'll get chatting with the management in just a bit. That stock as well as reacting to its numbers up close to around 4.5%. Zydus Life as well, that's up close to around 3.5%. And Bank of Baroda up close to around 2%. On the flip side, you have Adani Enterprises that's pulled back quite a bit. Manappuram Finance as well is down close to around 1.5%. And Dalmia Bharat, though the numbers look very, very good, and even the acquisition was fairly good, the problem is that the stock ended high with a gain of 3.5% on Friday itself. So part of the good news is already in the price, and that explains why that stock has opened up with a bit of a negative take. Pull up JK Cement as well. Let's see how that one's opened up. Those numbers were disappointing. We did see margin compression more than expected, so that's down close to 100%. And Birla Corp as well. That's the other one that was reacting to its numbers. Profitability not really coming about. They have expanded capacity as well. But we'll chat with the management the next hour or so and try to understand what's the way ahead. So Birla Corp is the other stock that has opened up in the red. For the time being, though, the Nifty, after moving to the low point of the day, we have seen some bit of stability, 17,771. That was the low. So we have popped up 25 points from there. What else, Prashant?
No, I mean, absolutely. Banks, Nigel, are, I think, doing a little better. The earnings have come in stronger for names like State Bank of India, Bank of Baroda. Actually, we should have Bank of Baroda as well and see how that is doing. Had a decent reaction to the earnings which came during market hours. Those are things which are looking up. Otherwise, I mean, it's a more mixed kind of picture. Even on Friday, even as the Nifty and the Bank Nifty did very well, broader markets suffered. So, I mean, they were down, declines outnumbered advances. So we'll have to kind of wait and see how things pan out. So the Nifty is down 60, the Bank Nifty is up 90. So it's a very clear kind of contrast. The mid-cap index is up about 0.25% as well right now. Venugopal Garre is the Managing Director at Bernstein, and he's joining us right now to take some questions. Venu, great to have you with us here. Thank you very much for your time. We've seen a fair bit of upheaval, right? Turmoil in markets over the last week and a half or so. And I just wanted your sense in terms of whether it's like this kind of price action is likely to continue, or you have a more sanguine view in the near to medium term.
Thanks, Prashant. So, yeah, I mean, the volatility probably would have caught everyone by surprise, especially what happened in the last 2 weeks. And the reality is that I would say that this is, while events will happen, events will end, there'll be new events which will get generated. So what I basically mean to say is that this year, brace for volatility. And a lot of volatility, in my view, will be orchestrated events because this is a pre-election year. Now, the reality is pre-election years, in fact, we had established as one of the themes in our early January sort of outlook reports where we highlighted that usually you don't tend to see returns in the market or a meaningful positive return in the market in the election years. Now, the backdrop to that is if you see past elections and look at what happens in terms of the disruption that gets created. If you recollect the previous election, we had a no confidence motion. We had, farmer distress related protests, being created. And then you had these defense deal scrutiny. So, and of course, this is in the backdrop of, the challenges around ILFS bankruptcy and prior to that, the fallout impacts of GST implementation and demonetization. So that was all of those agendas basically impacted, during that time. Now, the reality is this time we were expecting primarily inflation and the mid to bottom end of the pyramid not doing that well, probably is one angle for that. But what happened in the last 2 weeks suggests to me that potentially you could see more such, uncertainty happen through the year. Now, volatility doesn't mean wait up, everything goes down. Volatility works both ways, so it's going to be eventually, of course, not much return.
Okay. I do want to, Venugopal, good morning and thanks for joining in. I do want to, by the way, just get our viewers to look at the market once because it's really all over the place. It hasn't made up its mind. The Sensex and the Nifty are under pressure, down about 200 points in the Sensex, but the mid-cap index is moving up. So there is some traction in the mid-cap index and a lot of stocks. M&M Financial is now up 9% post its numbers. Paytm is up 5% post its numbers. Interglobe Aviation, Indus Towers, Vodafone Idea, all up almost about. Indus Towers and Vodafone Idea are actually up 10% apiece, so don't lose sight of that. So this market is rewarding good data points, and of course then you have the Adani Group stocks on the other side. Venugopal, what do you do with earnings now? I mean, after looking at the Q3 print, are you seeing more downgrades than upgrades? Because we've had a fairly decent run, right? I mean, the latest, of course, being SBI, ITC, Tata Power, all doing well. Your thoughts?
I would probably say that to a large extent, it was more a neutralish earnings season. There were, certain sectors which are exhibiting positivity and certain sectors which are actually seeing, weakish numbers. Now, the reality is since financials is the largest sector out here, and that's where we've actually seen positive sort of numbers coming through across the board. It probably, gives us feeling that things are okay, especially in terms of how the economy is shaping up. But then if you contrast it with consumption related companies, you've actually seen in general weakish numbers, especially those related to urban consumption. In fact, we've heard some rural consumption weaknesses as well in some results. So the reality is, between these two large sectors is a pretty different, trend that we are seeing at this juncture. See, outside of this, even from a point of view of certain sectors like industrials, even one of the larger companies essentially had a margin miss, for example. So it's all over the place outside of this, no unique trend per se. So all in all, I would probably say this result season in general is not a major driver for upgrades. So I don't really see much of a change, post these numbers. And neither is it giving you any directional trend for turning, incrementally positive.
Okay, so there is no direction if you're looking at right now, but there's one thing that we noticed in the budget this time. Infrastructure spending is there, but it's moderating compared to what we saw in the previous budgets at least. Can you explain more on that, and what would this mean for some of the infrastructure stocks or pockets that have seen a really smooth run up until now? Case in point, L&T.
Yeah, so I would probably say that one of the key aspects that I want to highlight on this is that the general theory post the budget and all the commentary was primarily about a pretty substantial increase in capex. The reality is actually capex is not accelerating in the budget. Capex is actually moderating in the budget. That's the most important takeaway. And the way to look at that is, remember, there are always these accounting aspects of a budget that one needs to be very careful of. And if you were to think about just the infra part, which accounts for almost 75 to 80% of the 10 lakh crore number that you see, is actually going to be up only 20% year on year compared to 31% growth in the previous year. And the reality is that this is happening primarily on account of the fact that you have these extra budgetary resources, for example, for railways has actually been cut, and that has in theory been taken over by the capital account, which is the budget, right? So it appears, for example, that railway capex is up 50% YOY, but in reality, it's up only 15%, right? So those are the anomalies. So it's like, it's 20%, if they're able to deliver, it's an okay growth. It's in line with expectations. But the challenge here is that if I were to sort of look at the state allocation, which has been done. Now, even if I look at last year, only 70% of that is getting consumed. So The challenge is if you're not able to consume that allocation which you're doing to states, then we'll end up at something like 15% growth, which is not necessarily great at this juncture. That's one part of the thing that I wanted to highlight. The second aspect is, remember, private sector capex is not really, it was expected to be great anyways this year. We were thinking it'll probably start looking good in 2024, 25-ish, years, calendar years. But the reality is at this juncture, with what we have seen in the last 2 weeks, I think the banking system will be generally a bit careful about lending to private sector, especially, if it is linked to infra. That is a reality. So the heavy lifting has to be done by the government, right? So, I mean, even though private infra expenditure is not that great, but it's still an incremental contributor, right? So overall, I would probably say it's neutralish to negative from an infra point of view relative to expectations when we head into this year. So that would be the summary.
Okay, all right. Hi, morning, Venugopal. You also write that the budget has led to a net reduction in transfer to consumers. Could you explain that to us?
Yeah. So the idea was not to basically get out all negatives from the budget, but I wanted to put a realistic picture. So think of how the world works, right? So there are 2 or 3 things we highlight here. Firstly, if you look at the tax side of changes, I think that's pretty welcome. But the reality is that is the best the government could have done. Now, they have quantified. That's basically a $5 billion odd extra expense that they would have to incur, assuming people, are shifting based on the expectation of shifting to the new tax regime. Who is getting that, right? That's basically the taxpayers, which typically, let's say, is the top households, because they have incomes which are pretty much, in some way salary incomes. So that's a top end of the pyramid. Let's say the top 20, 30 or 40 million households, $5 billion transfer. But look at the reality. In the last 18 months, we've actually seen a $150 billion increase in product prices, and we have quantified that in 2 of our surveys. So this $5 billion is not going to move the needle, firstly. It's a $150 billion inflation impact on consumption or consumer product prices increasing. The second part is that at the bottom of the pyramid, subsidies have been reduced, right? And I'm not talking about fertilizer subsidy, because that eventually will play up in food inflation, assuming their assumption on fertilizer subsidy is correct. But let's put that aside. Look at Manrega, for example. The allocation has been substantially cut. Yes, that's great from productive, point of view. But the reality is what was direct dole out to the bottom of the pyramid has actually been taken away, right? So net, if you look at the entire spectrum of the households in India, this budget is not necessarily, transferring more to consumers. So that's the sort of, viewpoint that we have.
All right, Venugopal, we'll leave it at that. Thanks a lot for joining in, and all the best for the year to come. Well, that is the word coming in on the market, but let's focus on individual stocks. Now, by the way, the overall market is really all over the place, as I was saying. The mid-caps were trending in the green. Now they've moved into the red. The Nifty has now moved to the low point of trade. So this whole Adani overhang is something that continues to sort of cloud the market mood. Adani Enterprises still down almost about 4%. Ambuja Cement down about 2%, and a couple of other group stocks as well.
I think the Nifty is, we should have it up. It's also down about a full 90 points now, right? I think we are at the day's lowest point on the Nifty as well. And the big sort of, crack happened post 9:20. I mean, actually, this is the last 1 minute or so, minute and a half or so we're talking about, from 17,782, just 30, 40 points like that in the last, barely 2 minutes or so. So this is the price activity. Volatility, it's not, is still very, very high. And for now, with the first 15 minutes, we are seeing a fair bit of it. The volatility index is up some 4% as well on your screen right now. Sonia.
Okay, ITC, by the way, is at a fresh 52-week high. So amidst all this volatility, ITC is kind of the oasis, in the desert, now at a fresh 52-week high post its numbers. But JK Tyres posted a decent set of Q3 earnings. Revenues saw an 18% rise. Margins expanded marginally on account of softening commodity costs, cost controls, as well as price hikes. Anuj Kathuria, the president, India at JK Tyres, joins us on the show to talk more about that. Anuj, good morning and thanks for joining in. I was going through the conference call highlights, and within that you mentioned that the volume growth in Q3 was around 10% compared to what you saw same time last year. Can you tell us how is the demand situation now? Do you think this double-digit volume growth is something that can continue towards the end of the fiscal? And what is the expectation for FY24?
Yeah, good morning, Sonia. So as we saw that the Q3, we reported a good growth. The revenue growth over the corresponding quarter was around 17%. and the EBITDA margins are also up to 9.6%. So that is the good news. The demand is holding up. In fact, we expect that in the current quarter, that is Q4, which is generally a good quarter. So further demand should be, should be good, should be robust, and both in the OE segment as well as in the replacement market. In the OE, the growth has been much better. Replacement market also, the demand is robust, and going forward, we expect that this will hold on.
Can you give us some numbers? There was a 10% volume growth in Q3. Do you think you can do the same in Q4? And for FY24, what is the outlook in terms of volume growth?
See, in terms of what you're asking for is in terms of volume, we have also seen that, owing to the increase in the commodity cost, the prices have also been going up. So definitely it's a combination. The top line growth is coming out of both volume growth as well as the increase in the price. So we expect that the volume growth for Q4 should be even better than what we saw in Q3.
Okay. All right. Hi, Anuj. Good morning. The other heartening aspect is margins. They have improved a little bit and they're on their way to double digits. So do you believe there is more scope for margins to improve from year on? And also, so I want a number out there, you could give us a band. And also, how's your balance sheet looking? Any debt reduction targets for FY24?
Yeah, so, as far as margins are concerned, the EBITDA numbers are inching up. We had reported 9.6%, which is almost looking at the double digit. Q4, as I mentioned earlier, is expected to be a better quarter. So we expect that the EBITDA margins to inch up further. How much would depend on three factors. What is the volume growth that we see? Also, while there is a softening of the commodity costs, but again, how much of that will be experienced in Q4? Because certain things come with a lag effect. And finally, the market forces will decide what is the kind of the pricing. So a combination of all these three we expect that the EBITDA margin should be inching it further.
And on debt?
On debt, yeah, we are working steadily to reduce our debt. We have been able to make certain good repayments on the long-term borrowings, but we are also trying to see that how we can, make the working capital even smarter. Over a longer period, we intend to reduce up to almost 35%, maybe in the next couple of years, and that would help us de-leverage our balance sheet to a great extent.
Okay, you also mentioned that EBITDA margins will inch up further going forward. In the conference call, you said that you have hiked prices by 3% so far to offset higher RM prices. Any more price hikes that you have planned? If yes, what would the quantum be like?
As you know that, the pricing is a function of the market forces. So it all depends on how the demand plays out in the months of February and March. January was a month where, the number of working days in certain regions are lower because of the festivities. And also, northern region experienced a very harsh winter. So, but I think so February and March should be much better, both from the OE side and the replacement side. So let's wait and watch, keeping our fingers crossed.
Okay. You've also developed a new range of electric vehicle-specific smart radial tires across categories, right? Trucks, buses, LCVs, and now we're seeing EVs pick up in a big way. Will that help you operationally? I mean, are these tires that you developed for EVs higher than your regular margins? And will that help increase your blended margin picture?
So we are working on tires which are specifically meant for EVs, whether it is in the truck and bus space or even in the passenger car. Last week we launched the Ranger HPE, which is meant for the passenger car. It is a high-performance tire which is specifically meant for the electric vehicles. These tires have a lower coefficient of rolling resistance. They also have much lower noise levels and comply to all the parameters. We will be able to position these products into the market very competitively, and definitely with the, these are all premium segment tires. So they will be having better margins as compared to some of the other tires. Also in the truck and bus, we are working on both tires which are specifically meant for electric vehicles. We have already started supplying to the major OEMs, especially, for the buses that run in Delhi. Those have our tires, the EV buses. We are also working for, other than the EV buses, we are working with the OEMs to ensure that we deliver them tires which are making the vehicles more fuel efficient. There are regulatory norms that are upcoming which will mandate that the vehicles are having better fuel efficiency. So we are working on both.
Okay, all right. Anuj, just to clarify on the debt aspect, currently what is the debt in the books? Overall debt, 5,000 crores?
Yeah, a little lower than that.
And in the next couple of years, so by 2025, you're saying it'll come down by 35%. So it should be south of 3,500 crores by 2025, realistic?
That is what we are working towards.
Okay. All right. So by 2025, the debt number will come down by around 35%. We have got that. And also, the Mexico business, that's a smaller part of the overall business, but margins out there are still struggling. Have things bottomed out there and margins will improve even in that business?
Both our subsidiaries, whether it is Cavendish or Tumbles, they are doing quite well. In fact, the margins in both the businesses, at least in the Q3, were robust. And we expect that while there are challenges in the international market, but we'll have to see how we kind of navigate through these times. But as of now, we are holding up.
Okay, as of now, you're holding up. Just one more question, a slightly broader term question. The tire industry is going up the technology curve in different ways, right? Whether it's related to electric vehicle technology, as we just discussed, or even enabling of the labeling norms, like, which the government has put forward. So all of that put together, what do you think happens to the overall capacity of the fixed assets? I mean, will you have to sort of scale up your capacity in the new EV-related tires? Will there be a separate cost going forward?
We have been, utilizing our capacities very well. They are in the range of 90%. Going forward, we had announced last year capacity expansion programs. The total capex outlay for that was 1,100 crores, out of which 300 crores, which was meant for the the debottlenecking and the extraction, has already been implemented, and we are able to realize the additional output from there. Two other programs, one for the PCR segment and the other for the truck and bus radial, that is also being done right now. And we expect that the enhanced capacity output from these expansion programs should be coming through in the second half of the coming financial year. So these capacities are being set up with keeping in mind the future requirements of the products, whether they are for electric vehicles or they are for the premium segment in the passenger car. So those things are built into our programs.
All right, Mr. Kathuria, thank you very much for your time. It's a pleasure. And, it's not often that we have you on the air, and I hope you're back on more often. Thanks very much for joining us with that conversation. Well, we'll take a quick break here, but before that, look at the market, which is down 110 points. And as we were highlighting, I mean, like Friday, there is very clear weakness in the broader markets. 1,200 stocks now lower, and about 850 stocks are higher. And you just have to look at what is selling off, and it's a long list of volume-led losses which are coming through. Adani Enterprises and Ambuja are the two biggest volume-led losers right now. 5.5 lower on Adani, and Ambuja is down 3. MCX is down 5%, 5.5%. Manappuram is down about 3.5% in reaction to numbers. LIC Housing is down 4% or so. And there are so many of these 3.5% losers that it's a long list out there with what's going on. Indus Tower with a 12.5 pop is the biggest gainer. But Paytm is the biggest volume-led gainer with a 5% pop. Now, it's come off the highs of the day. M&M Finance is doing very well as well on the back of third quarter earnings. And we speak with the management in a bit. We take a break here. We have the management of Star Health Insurance join us on the other side. Anand Roy is Managing Director. We'll speak with him in just a bit. Later.